Investment companies are in many ways similar to other funds such as unit trusts, OEICS or UCITs. They are collective funds where shareholders pool their money and invest this across a wide range of different investments to spread risk. Like unit trusts, they employ specialist fund managers to look after the portfolio of investments. They can meet a wide range of investment objectives, anything from a high level of income to long-term capital growth.
Investment companies are actually companies that are owned by and run for their shareholders, so they're very different to other products which are promoted by sort of product manufacturers. And one of the key differences is they'll have an independent board of directors. They head up the company. They're under a legal duty to look after the interests of their shareholders for the long term.
One of the great attractions of investment trusts is the fact that there is this issue of corporate governance, and the fact that the boards do control the investment managers. The investment managers are accountable.
So that means, for example, they monitor charges. They also look at performance and monitor performance and can make changes if that's not going well.
It's quite a powerful feature of investment trust companies. It means there is somebody there looking after your interests, which if you're a relatively small retail investor, I think can give you a lot of confidence.
Investment companies are closed-ended, unlike unit trusts, which are open-ended.
In an open-ended fund, you have investors, they'll put their money into the fund, then that money has to be invested into additional assets. If they want their money back, the fund manager potentially has to sell assets to give them back to investors.
With the open-ended fund manager, one of the key considerations is to actually manage fund flows, liquidity, and that might be coming into the open-ended fund or going out of the open-ended fund, which is obviously could curtail their long-term investment decision-making process.
In a closed-ended fund, you simply trade the shares backwards and forwards between individual investors. Now that has no impact on the underlying portfolio.
Because the investment company manager isn't influenced by the day-to-day buying and selling, they can take a longer term view on the investments that they want to buy. They also can buy things that on the surface are quite illiquid. They can buy into private equity, very nice area in my opinion, in infrastructure funds perhaps, where there's a long-term hold.
Investment companies also have a special advantage when it comes to providing a reliable income. Unlike other funds, they can keep back some of their income each year. When times are tough, they can use these reserves to maintain or boost their dividends.
It enables investment trusts to smooth income payments, and if you look back through the records, there are now probably 20 odd investment trusts that have increased their annual dividends every year for the past 20 years. And that is something which no unit trust could ever do.
Investment companies can also boost the income they pay to investors by paying dividends out of capital profits.